Welcome to 3 and 3. My name is Jason Weaver. Today we're going to be talking about GDP components, recession, and dividend growers. There are four components of nominal GDP. In the first quarter, we had nominal GDP at 6.5%. Personal consumption, which was 2.7%, which is all goods and services produced by households. Business investment, which was up about 1.2%, and that's goods and services purchased by private businesses. Government spending at minus 0.5%, which includes federal, state, and local governments. And net exports, which was negative 3.2%, which is the dollar value of total exports minus imports. So although the first quarter had a nominal GDP of 6.5%, with inflation as high as it was at 8%, we had a negative actual real GDP of minus 1.4%. Now some of that actually happened because the fourth quarter of 2021 had a very big build in inventory. So what happened is that a lot of businesses built up their inventories, probably concerned about the supply chain into 2022. And as we rolled into the first quarter of 2022, we can see that we had a negative drawdown on inventories, which affected then GDP. Also, net exports were negative in the actual first quarter. Typically, we find that net exports are negative in the first quarter, but that negative 3.2 number then had a big effect on making that first quarter GDP negative 1.4%, when we were actually expecting a 1% increase. So we'll see what happens going into the second quarter. So although numbers change from one quarter to the next, and you can see that the first quarter of 2022, as we discussed, had a negative reading, we are expecting the second, third, and fourth quarter to have positive GDP readings at 3%, 2.7%, and 2.2%. Now that's not as high as what we experienced in 2021. And that's where we see the stock market has sold off because growth actually is slowing. We're not expecting a recession, but that's up for debate as we go into, again, the later quarters of this year. So recession. So the definition of recession is 2 consecutive quarters of negative GDP. And since 1953, the average length has been 10.3 months. It's interesting enough, though, the S&P return is not all that bad. As we look at the lowest return in the year leading up to recession, it was negative 3%, and followed by 6 months before that of minus 2%. The average loss of 1% during a recession reminds us that we need to stay invested because timing the market can be very difficult. So the stock market is a leading indicator. As you can see from the yellow line, markets typically peak before actually cycles peak. Now what happens is that, again, that stock market is predicting that we're going to see a slowdown into the future. Now the nice thing about stock market is that even though we see this drawdown, they recover very quickly, even as the economy doesn't recover until maybe a couple months after. So one of the investment strategies that makes sense during these times is what we call dividend growers. Dividend growers are companies that are growing their dividend consecutively quarter over quarter. And what that helps is actually, it helps enhance total returns, because as an investor, you're getting the potential appreciation of the stock, but also that dividend, and that gives you an overall total return. They can provide a regular source of income, and they also provide that downside protection because that income attracts investors as stock prices get lower. Okay, so looking at past performance from 1978 to 2021, you can see that dividend growers provide you protection in many different types of markets. So in bull markets, we're going to see appreciation, maybe not as high as the non-dividend growers at 24%, but still about 20% on average. Now in those bear markets where it's more important and that income attracts investors, dividend growers have had a negative 12.5% drawdown on average, whereas those non-dividend payers at minus 30%. Now over that time span, dividend growers actually have even performed better than those non-dividend payers at 13.8% versus 12.2%. Thank you for joining us for 3 and 3.